Okay, welcome back. We are in Chapter 9, page 4, and we are doing example 2, which is going to be illustrate fair value through net income model. Okay, so Granger Corp made the following purchases the first year they did them. On February 15th, 94.50 shares at 35.18 of Lee Corp as a commission, and they received a per share dividend. April 1st, 52.50 shares of Richard common shares, $52 per share plus commission. And on September 10th, purchased $73.50 of Ekstrom's preferred shares, $27.83 and commission. On May 20th, Granger sold $31.50 of the Lee common shares at a market price of $30 per share, less brokerage commissions of $29.93. Year end, they've given us balances. And the chief accountant tells you that they hold this investment with the intention of seller to earn short-term profits and accounts for them using the fair value through net income model. We will always tell you that. No separate reporting of dividend, other types of fair value through net income investment and losses. So all of them go into investment income, except for gain or loss on sale of investment. The alternative, if it didn't all go into one, dividends is dividend income, interest is interest income, and fair value markup equals unrealized gains or losses. Okay, so you'll either see this kind of thing or you'll see everything go into here. So, they follow IFRS 9, prepare journal entries to record the investments, and then the sale on the 20th, and then the adjusting entries at the end of the year. Okay, so on the next page you should have enough space for everything, page 5. Keep this handy because you're going to have to read the numbers from it. So, let's start with the first date, which was January 15th. And what happened on the 15th? Okay. So we purchased Lee's shares. So let's try piecing it together. What are we getting? An investment. Now, generally with investments, because there's different methods, it's helpful to call it an investment in fair value through net income, and you can put the name there if you want. Wiley Plus will probably just have a fair value through net income. It might not have the name, so use whichever shows up. Okay, so we said with fair value, and I'm going to put this other page back, just page 4. Transaction costs are expensed. They're expensed, but we're only using one account, so transaction costs are going to go down here. So this is including transaction costs. Okay? So, transaction costs are expensed with this model. They have to go down here with the investment income loss. So, we know we're going to have the investment. We know we're going to have investment income loss, and we're going to shell out some cash. So, let's figure out how much cash we shelled out first. It says we purchased 94.50 shares at 35.18. Now, is that the only amount we had to pay? No, we had to pay a commission. So we're going to add the 2079. So if we calculate that, that works out to 334,530. Now, the transaction cost goes in here because it's expensed, it's separate. Capitalized is the opposite, and then it would go all in the investment. But we'll get to that when we do FV through OCI. So this is just going to be the 94.50 times 35.18. So that's 332,451. Make sense? Okay, the next date something happens is January 31st. So January 31st, receive dividends from Lee. So we get dividends, so that's going to be cash. Now, we could put dividend income or investment income. What does this one want you to do, this question? They want you to put it investment income or loss. So investment income loss. And they said it was $1 per share. So it's $1 times 94.50. Okay. Now, the next date is April 1st. And we purchased Rich's shares. So, actually, for April 1st and September 10th, why don't you hit pause and try and do the entries so you can practice, and then come back and see how you. I'll just keep going. So now that you've come back, hopefully you got these right. We're going to have debit investment, fair value net income, and you can put rich if you want, but you don't have to. We also had a broker's fee. And we paid cash because it doesn't say otherwise. So for the investment, we had 52.50 shares times 55, which go to 887.50. We had investment income loss of 3,539, credit cash 292,289, which is just adding those up together. And then September 10th, we purchase Extrem's shares. So we're doing this again. Debit investment, fair value net income, Extrem if you want, debit investment, income loss, credit, cash. So this is 73.50 times 27.83, and works out to 204,551. Our commission fee was 3,056, which means cash is 207,607. Okay, so that should be pretty straightforward now that you've actually practiced it. And I'm just drawing a line because that takes care of all the purchasing. Now, the next day something happens is May 20th we're going to sell some shares. So, May 20th, we sell 3150 shares of Lee's. So piece this together, you guys, with all these entries. I realize they are open book, but once you hit CPA or work and stuff, you can't look up every single entry. And you often will run into entries you haven't seen before. So piece it together. Ask yourself what's happening, because you can't remember all these for the CPA. So what's happening? We sold some shares. So what are we going to get? We're going to get some cash. What are we giving away? Well, we're going to credit investment fair value through NI of Lee. So we're going to get rid of some of Lee's shares. So let's do those two pieces and see where we end up. Okay, let's just first do a little T account for investment of Lee, just to see what they've got in there. Now, just so you know, if you bought all these three investments on one day, you could combine them into one entry. Okay? Because what you'll actually have a main ledger account for all your investments in fair value net income, and then you'll have subsidiary accounts for Lee and Ekstrom and Richard. Okay? So, Lee, what did we start with? We started with investment of 32451. And that represented 9450 shares. Sorry, that should say shares. 9450. So how many are we selling? 3150. We're going to leave it with 6,300 shares left. Okay? So that's just a little kind of running thing of what's happening. So let's try piecing this together. Let's do this one first. How much cash did we get? Well, it says we sold 3150 at 37. 3150 times 37. But what happened to the brokerage commission? We had to take it off. So we didn't get all that cash. It's minus 2079. Oops, sorry. 2993. I did wrote the wrong number. 2993. Okay, and that works out to 113,557. Now, because this share price hasn't changed, we could divide it or just use the number we paid for it in the first place and take it out. But I'm going to show you how it works when it's not the same. Okay? So, the investment for Lee, what portion of this are we selling? Well, we're selling 3150 out of 9450. So this is going to be 332451 times the portion we're selling. 3150 over 9450. And that's going to equal 110817. Okay, so we've got 113,557, 110817. It's not balancing. What does that mean? We have a gain or loss on sale. Okay? So, difference is gain or loss on sale, so we need more credits. So it's a gain on disposal or sale, matter, use what's there. And fill in the blank, and it's going to be 2740. So, just so you know, we take the 110 out, and we end up with 221,634. Okay. Now, technically you could use investment income or loss, but in this chapter on why they plus they don't want you to, they want you to use the actual gain. So that's the only time they want you to use it. Okay. So that was May 20th. Now the next time something happens is when? Year end. And what do we have to do at year end? We have to record year end. We need an adjusting entry to increase or decrease our investment to fair value. So, let's see what we have now. With these, you guys, because the transaction costs are expense, they're outside the account for the investment, you could just use the dollar values here, so the 35.18, the 55, the 27.83, take the difference and multiply it by how many shares you have left, okay? And that works for fair value through net income. Fair value through OCI, the transaction costs are going to be capitalized, so they're actually going to go into here. So you can't use that. That's why I showed you how to calculate the investment here using that, because it will always work. The other way won't, taking the individual share prices. It won't work for fair value through OCI. So let's do this and set up our little list of who we have. Lee, Richards, and Ekstrom. And we have before adjustment, we have the fair value calculation, and then we have the gain or the loss. So Lee's we know is now 221,634. Richards, we go up and see what we paid, 288,750. And Ekstrom, go up and see what we paid, and it's 204,551. Okay, so the fair value of Lee is now 6,300 shares left times 32, they told us at the question, 32 is 201,600. Richard still has 5,250 shares, nothing's changed, except now they're worth 58. 304,500, and Ekstrom still has 7,350 shares from here where he bought them, we bought them, and their share price is 29. Okay, so like I said, with these guys, you can, well, especially these two. These two, you could just take the difference in the share price to figure out the gain or the loss. Lee, you can't because you sold at a different price, and yeah, so this way will always work. So, did we have gain or loss here? The difference is a gain. Oh, so, oh my god, before it was 221, after it was 201. I was thinking of something else. 20034. Now Richards went from 288 to 304. So it went up by 15,750. That's a gain. And Extra went from 204 to 213, also went up 8,599. That's a gain, and that's a loss. So overall, there's a 4,315 gain.